My name is Max Leaman. I am the owner and CEO of LoanPeople based in Austin, Texas. I've been in the mortgage business for almost 25 years. Max Leaman, the loan officer, has been the #1 loan officer in Texas since 2010, top 10 in the nation based on Scotsman Guide since that time. And I'm kind of a jack of all trades here. So when borrowers first reach out, generally the first question that they have is, what is your interest rate? And people make that the primary focus of what they're trying to do, when in reality, the rate isn't the most important part, and it's definitely shouldn't be the only factor in making that decision. A lot of times people say, what's your rate? And my response is, I don't have a rate. We're going to talk about what your rate is, because there are so many factors that go into that. People want to know what they qualify for. But the more important question is, where are you comfortable? Where are you comfortable with on your max monthly payment? Where are you comfortable as far as the maximum amount of money that you're willing to put into the transaction to make it happen? From there, you can then start to devise a plan. Maybe a borrower is actually more comfortable with the higher payment, but you can start to strategize of, I have X amount of dollars to use, I can pay off debt. I tell most people when I talk to them, what you qualify for is mostly irrelevant. We need to talk about comfortability and where are you comfortable. Debt management is an extremely important part of the entire puzzle that you're trying to put together. If a borrower tells you they're comfortable with $3,000 a month and they've got $100,000 to play with, that doesn't necessarily mean the best course of action is to use $100,000 to buy the house. I've had situations where we look at it and we say, okay, we're going to only use $50,000 and we're going to use $50,000 to pay off debt. And a real life example happened recently where her mortgage payment was higher than what she wanted, but the overall debt load that we saved between mortgage payment and debt paying off was $800 a month. So you have to look at the whole package. People always want to talk about points. Should I pay points? Should I not? What do points get me? Things like that. There's a lot of different factors that go into it. It's not just rate, but it's the cost of getting rate. So if I have a $500,000 loan amount and I pay 1 point, that's $5,000. Typically, 1 point will get you somewhere between 1/4 to 1/2 point lower in note rate. The key is you have to figure out, what am I paying up front and what am I saving on a monthly basis with this upfront amount that I'm paying? Then you can figure out what your break-even point is. Right now, I am of the opinion that a good break-even litmus test is about 2.5 years. If you can break even in about 2.5 years, that will generally, in my opinion, make sense to buy the rate down. Why 2.5 years? We think there's a high degree of likelihood that refinances are coming in the next 12 to 36 months, but you don't know. To me, 2.5 years is a good hedge against if rates don't come down fast enough for you to refinance. And if they do come down to where you refinance before your break-even period, you're saving money anyway. Think that for buyers, they need to look at not just what this is costing me now, but what is the strategy for potential changes in the future, whether that be refinancing this, turning this house into a rental property and buying a new property, planning for children, planning for different debt loads. All of that has to be taken into play. People generally ask about the difference between refinancing and recasting. Recasting can be a great option. A recast is when you take a lump sum of money, you apply it towards your principal balance, and then you re-amortize the loan, recalculate the payment over the remaining term of the loan. Refinance is when you do a whole new transaction and you actually lower the interest rate. There are more costs involved with the refinance, but you are lowering the rate and possibly changing the terms, either by doing a new 30-year, going to a 15-year, something like that. On a recast, the fees are very minimal, usually in the range of about $500. You do not get a different interest rate. Your interest rate stays the same. You are merely paying down the principal and lowering your overall payment. Vetting out loan officers is a very tricky thing for borrowers and buyers, especially those who have not done this before. Everybody thinks I'm going to call this loan officer, they're going to tell me the rate, and I'm going to shop that around. A lot of loan officers in the beginning, the unscrupulous loan officers, will short the rate. You cannot lock in an interest rate for the most part until you're actually under contract on a property. When you call and you speak to some of these loan officers, they will tell you if the average rate today is 6.8, they'll tell you the rate's 6.2 or 6.3, and they won't put much context behind that. So they're either just shorting the rate because we know that the market changes every day, or they're factoring in multiple 2, 3, 4, 5 points in this rate that they're quoting. The real way to vet a loan officer is not to talk about rate. First of all, you should go look them up online. How long have they been in the business? Do they have reviews? What do those reviews say? You can also look them up and see if they change companies a lot. There's a lot of loan officers that will bounce around from one company to the next, year after year, 2 years after 2 years. Why are they doing that? Most mortgage companies out there are good companies. There's some bad apples, but if somebody's moving around a lot, you should ask yourself, and you should ask them why. What's going on? Secondarily, the most important thing, especially in the pre-qualifying process, is finding someone you're comfortable with. This is going to be a lot of information. It's going to be a learning experience. Starting with the person who quote unquote quotes you the absolute lowest rate does not mean they're doing a good job helping you get set up on this journey for success, right? Realtor referrals for loan officers are generally the best type of referral. Second would be friends and family. Third would be if you go online and find someone that's very highly reviewed. But when you look at a local loan officer referred by your realtor, they're going to be the best performing for you. While the borrower is the loan officer's customer, the longer standing customer is that realtor. And if the loan officer does a bad job on that transaction for whatever reason, that is a poor reflection on the realtor, and B, it ends up making the realtor not necessarily want to send business to that loan officer. Using a local loan officer is extremely important for multiple reasons. Number one, the local reputation. Whether it be with the listing agent or the buyer's agent, their reputation's on the line. Number two, what is your relationship with the title companies in town? Are you able to work together? Are you familiar with their process, which will allow not only for a smooth behind-the-scenes transaction, but closing and funding? When the borrower goes to close, you want to sign and you want those keys pretty quickly. Also, appraisals are a very big deal. You want to have a good relationship with the appraisal management company because you want good, solid appraisers that understand the market and what they're looking at. If you get an out-of-town loan officer, their appraisal management company may just hire a San Antonio appraiser to appraise an Austin property. I've seen people come from Dallas and Waco in certain occasions to appraise an Austin property, and they don't know the market. That's when you start to have value issues, adjustment issues, appraisal issues, and it can really blow everything up at the end. The most important things to think about for anybody buying a home or getting a mortgage, are you working with a very solid quality loan officer who has your best interests in mind through the whole process, that's going to help you strategize, again, not only for this transaction, but for the future transactions on this particular property and other transactions coming up, as well as taking into consideration future life events that may or may not come up. Not focusing all on interest rate. Yes, interest rate is important, but what's more important is what does that rate cost? Is that the right scenario for you? Should you pay points? Should you not? Should you put less down? Should you put more down? How are we structuring the payment? These are the biggest things that people should consider when talking to a loan officer and getting pre-qualified for a home. Thanks so much for having me. If you have any questions, if there's anything that I can help with, please reach out anytime. My email address is max.leaman, Leaman, @loanpeople.com. Our team email is leamanteam@loanpeople.com. And my cell phone is 512-293-1239. Reach me any of those ways. We're always happy to help.